Well, the regional banking crisis is clearly not over. I think we have Western Alliance and PacWest or something that's now down 40% today. We had a Fed meeting yesterday and an ADP report Wednesday. We got a jobs number tomorrow. Lots of stuff going on. We got to talk to the one and only Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
Oh, you still riding high from that event in Vegas, I'm sure?
Yeah, I mean, that was a great event. I mean, I really, really have to say myself, that we did well.
We did it.
We did it. We pulled it off somehow. We pulled it together,
Yes.
and it was really great. And it was like I said in the last segment, it was great meeting you. That was one of the highlights for me to finally actually meet
Yeah.
in person. So, yeah, really enjoyed that.
Very cool. Well, let's talk about it. Where do you want to start? Regional banks, the Fed meeting, ADP report,
Well, let's
jobs
just
number
start
on
with the
Friday?
easy stuff. Let's talk about the data first, and then
Okay.
we can talk about First Republic and the next banks and stuff to go.
Okay.
But yeah, so I mean, data. Look, the Fed raised as everybody in the world. I mean, I don't think there was anybody in the world who didn't expect them to do what they did. So they did it, and now they're saying stuff like Powell said. They're making noises about pausing, and Powell even said, which I thought was slightly impolitic, but maybe it's still true, that a bank failure has the same effect as a interest rate rise.
Yeah. Yeah.
So, so I mean, I think that what you and I have been talking about for a while is that the Fed is going to slow down, if not pause altogether,
Yeah.
on interest rate hikes at this point. I think they've kind of realized that they've made their point, and they probably can't push it any further.
Yeah. 500 basis points in
Yeah,
14 months.
yeah.
That's never been done before. That's
It's
fast.
it's fast. It's fast, and clearly the pain is showing. And we've seen it in these banks that didn't get ahead of this, right? I mean, there are definitely like this is sort of what happens every time. I mean, there's a larger story here, not in the economic sense, but there's a larger story here in terms of how people act in the market cycle, right? And there's always players. They could be investors, they could be lenders, but there's always people who just buy the narrative that the good times are going to go forever, and they don't protect themselves, right? And they drink the Kool-Aid. They don't hedge their bets, and they wind up, when the good times change even a little bit, they're on the wrong side of that equation. And that's what you're seeing happening with some of these banks, and with those guys in Houston who got foreclosed on. And you're going to see more of it, because there are always players who refuse to
Yeah.
hedge. Yeah.
Well, I think Michael Milken, I think his name is, just came out yesterday. I think it was a CNBC or Bloomberg video talking about the banks repeated the same mistakes again. And that's basically very simple: borrow short, lend long.
Yeah.
And when rates go the other way, you get crushed.
And there's something about the incentive system, right, that rewards this behavior, and and I don't really know how you solve it, right? I mean, because it seems like, well, on the one hand, the way to solve it is to have the very nasty market consequences of acting badly. On the other hand, when that happens, you don't want a cascade of bank failures that tip the economy into another depression, right? So, then the government winds up bailing them out and saving them from themselves, and then they don't learn the lesson, right? So there needs to be some more effective way of punishing people who engage in this behavior. But on the other hand, I mean, the incentives are so strong for them to engage in it, and the narrative is always that the party is going to continue forever, right? I mean, you see this at the late stage of all these cycles. This will go on. There's a new paradigm. Nobody actually said new paradigm this time around, but
That's true.
because they couldn't say that, because everybody would laugh at them. So they instead said, look at the trend line of interest rates. It only goes in one direction, right? So and look at the federal budget deficit. The government can't afford to raise interest rates, so they won't. And there was a lot of evidence being marshaled behind the idea that this won't change, so therefore we don't have to be careful. And here we are, right? So
so I was kind of disappointed with Powell's kind of presser, because again, he brought up the notion that a pause is now clearly on the table. I've always said that the next meeting is a pause, so I got to be very clear how I kind of articulate that. I think a pause is coming no matter what. I think the data gets very bad from here, but the fact that he put it on the table explicitly,
Yeah.
means that the 10 years going down, and it's down again today. And I think what will happen very shortly is the spread between the 10-year and mortgage rates will start to come in, because banks will price in the terminal rate, and
Right.
they'll bring that down. So in my world, residential, we are very quickly going to see sub 6% interest rates, and demand's going to go up with no supply. It's going to get bananas again. So I wanted Powell to be more, more vocal,
Yeah.
just to buy more time. But now I just checked the 10-year again. It's down almost 8 basis points today. So
yeah. Well, I mean, it's just going to take a while for the market to recalibrate, though, right? I mean, because I think what happens, and this will be like, so the multifamily world is a little different because of the debt term, right?
correct.
In single family housing, you get fully amortizing loans, right? So it's going to be whatever the term is, you're paying the loan off if you go out the whole term, right? So you do have a situation where there might not be people selling until you start having like people selling because, well, they have to take a new job somewhere, or someone dies, or there's a divorce. There's kind of those forced
life
events cause sales, right?
They can, yeah.
Yeah. So, but the market may just kind of get down to those, right? Because people they don't have to sell, and they're looking at like what they can get, and there hasn't been just enough time for like inflation to kind of kick in and raise prices and all that sort of stuff. So it's gonna take a while for the market to recalibrate. The commercial market,
supply side.
Yeah, on the supply side, the commercial market will recalibrate much faster.
Agreed.
Because the debt terms are usually 5 and at most 10 years, right?
Yeah,
so
it's a forced event. Exactly.
Yeah, exactly. So what you'll wind up with is, people don't want to sell, but they have to, because their debt is, they got to repay the debt. And if they can't, refinance at current valuations, then they're going to have to sell.
Yep.
Right. So you'll see prices kind of reach a new equilibrium faster.
I agree.
In the commercial markets than you will in the residential markets.
It's always the debt, folks. It's always the debt. And people don't get that. Both residential, again, the move-up buyers aren't selling because they don't have to, right? It's a lifestyle decision. And we just haven't had enough time for multiple lifestyle events. So we're going to see listings are down 28%. Wow. New listings, 28% from last year, which wasn't a big year for listings. So this is a mess.
Yeah, go ahead. No, I was just saying, I've just been surprised at just looking at sort of my local market about how, in spite of interest rates going up, the prices just continue to go up, right?
Yeah.
And the supply is so limited. And
exactly right.
Yeah. So
but what happens now, Jonathan, is we know it's 6.5%, which was roughly rates at the beginning of the week, is high enough to really keep demand to a manageable level given the low supply. We have evidence over the last 90 days that when rates go sub 6, which they did twice in the last 90 days, demand comes flying off the shelves. So now we have a population that knows that sub 6 isn't here for a long time. So with what the Fed just did, the 10-year now, then we're going to get rate, compression. We're going to be sub 6 in weeks. And it's just, it creates more demand and supply's not coming. So it's going to be a mess.
Yeah. I mean, I don't know what to say. Yes.
Yeah. Well, let's talk about jobs, because again, one of the things that Powell was very synced about was jobs. And we got an ADP report yesterday. We got a weekly unemployment this morning. Yep. So where are we at on the jobs front?
I mean, well, at least according to the ADP, I mean, we're up 296,000 jobs, right? Which is
expectation was 133.
Yeah.
That's a beat.
So the economy continues to just power along, right? In spite of the interest rates that are supposed to, cause a recession, and we're still not there yet. And you just wonder, like, well, are we going to continue to have inflation because there's just so many people working, right? And then Americans are flush with cash, right, in general. And they continue to work.
I mean, look at Vegas. I mean, I hadn't been to Vegas in 4 years. I used to go 5-10 times a year for work. I hadn't gone in 4 or 5 years since I retired. This was the first time. I was shocked at how busy everything was.
Oh, it's packed.
Shocked.
Absolutely packed. Yeah.
It's crazy.
I mean, I was telling people like, hey, I live in New York and I'm overwhelmed by the crowds.
Exactly. Yeah, exactly. It's like, wow, there's a lot of people.
Yeah, it was crazy. Yeah, and
we stayed till Tuesday and it didn't get better.
Really?
We stayed till Tuesday. It was busy all weekend. Monday was crazy. It was pretty wild.
So you know what? Oh, I'm sorry to interrupt you, but I mean, I want to, something I've been thinking about recently, I want to get your thought on, is that, so if you look at, so jobs are continuing to crush it, right?
Power along,
right? Even though interest rates are going up. And Americans after COVID, right, partially due to stimulus, partially due to the fact that they weren't spending as much money as they normally would because they weren't going anywhere or doing anything, have a lot of savings compared to normal. If there is a recession, I don't right now, I just don't see how the recession can be that deep, right? Because if people are flush with cash, right, they're going to continue to spend. That's going to cushion whatever we've got. We might see a financial crash, right? Or certainly look like a real estate. I mean, certainly in the office market. I mean, the office has got the double whammy of interest rates and work from home. So that's just, that market is going to suffer really badly. But you wonder, like, well, is it going to be limited to that? The stock market seems to be responding positively, right? I mean, so is it really just going to be limited to sort of assets like real estate that just sort of got ahead of themselves? We had a bubble, and we've had real estate crashes in the past that had really no effect on the broader economy, right? I mean, the real estate crash of the late 1980s didn't really affect the economy, right? I mean, we've sort of seen it happen. So
yeah, I think there's a couple of things, right? So as I sit here today, I think my base case is a couple years of stagflation, and I'll define that for the audience. So that's below trend growth, call it sub 1%, but not negative, with 4% inflation, right? Also, I think something I put out about 9 months ago still feels right. This is going to be a white collar recession, in my opinion. So I think when I say white collar, I not only mean tech and finance jobs, I also mean financial assets owned by, the top 10%, right? The top 10% own most of the stocks. The top 10% own most of this and that. And I really think that's what Jerome Powell was saying in Jackson Hole is, I'm coming for you. The top 10%. Because I think the bottom 90 and certainly the bottom 50, their wages are going up. Certainly inflation is a problem, but hopefully their wages are going up more. I've seen the distributions that I've seen, wages on the low end are going up higher than, the rest. Yeah. So I think, and again, I think to your point, a lot of people, have some money on the side, and I think there's, there's a chance that stagflation is where we go. I'm a little afraid for the economic numbers that come out middle of this month, because I don't think we've seen true evidence yet of just how scared consumers got that weekend after Silicon Valley Bank. And I'm on record saying that's when I thought the recession started. I think it's this quarter. I don't think it's, deep and dark, but I do think GDP for Q2 will be negative in the start of a recession. But either way, plus or minus 1% is kind of where I'm at.
So you're talking kind of like a technical recession though, right? Like defined as 2 quarters of negative growth, as opposed to like recession in a colloquial sense of like everybody's out of work and,
I think unemployment peaks at 4.5. So again, for my education, 6% full employment, then it was 5. So 4.5 historically is not bad, but it's worse than 3.5.
Right. Definitely pain for some people, right? For sure. But it's just interesting. It seems like the economic news is all over the place though, right? I mean, because you see you also see stuff like, the hospitality industry is doing well.
Oh,
Pass, pass,
ADP report, 145,000 jobs just in that sector alone.
demand for passports is like off the charts, right? Because
Wow.
people could, because the dollar is so strong and
Yep.
everybody's traveling abroad, and so I've been on a bunch of planes recently, and every single plane has been
Packed.
sold out. Yeah, packed, right? And it's, but then you hear like, oh, people aren't spending money, and I'm like, well, yeah, but, yeah, no, I mean, not as far as I can see, but of course, I live in my own bubble, right? So maybe
Yeah.
things are different in other places, but it's just. But that being said, my sort of just personal recollection of previous cycles has always been that kind of going into a downturn, you've got mixed news, right? It's always kind of like that's sort of like the signal for me that you're going into a downturn, is that the economic news is all over the place, right? And people are
Right.
arguing both sides of it, like, yes, we are, no, we're not. Look how
Right.
strong it is, look how weak it is. And I think when all those things can be said at the same time, it's usually pointing to the fact that something's going on, right? So
Well, I think we could talk about the regional banks. Let's kind of tie that in here, right? We had Silicon Valley Bank, then Signature Bank, then First Republic, and now more are coming. I think there's a lot of evidence that unfortunately a lot of financial institutions are kind of technically insolvent, right? If they were forced to market instead of hold to maturity, they're underwater.
yeah.
And I think there's a lot more pain. And then you add on top of that the next 18 months of pain in commercial and lending. And um, I think it's very clear that lending is going to dramatically reduce. And I think it gets worse from here. We had another bank get rescued, this one or acquired by JP Morgan. I think there's a couple more on the precipice. This is not going to be good for lending. And I think tighter lending is like rate increases. So, I think there's more pain ahead there. What do you think?
Yeah, I agree. I mean, I'm seeing it already in like deals that I'm doing. It's just it's getting just a little bit harder to get the money from the banks, right, to do deals. And
Yeah.
they're wanting, I'm talking with my loan broker, and he keeps on asking me for all this information. And I'm like, this is due diligence stuff. Why are you asking for me this stuff from me now? We don't even have a term sheet yet. And he's like, because the banks are so, you
Yeah.
know, anxious right now. I just want to give them like as much
Everything.
information as possible up front and show them how strong this deal is, and these how strong these borrowers are before we get any further, because we don't want to get into it and then have them, then turn around and say no, right, during due diligence. So, but yeah, that's sort of an indication of where things are. And on the other hand, we did, so I don't want to really get away from regional banks that much, but we did in the conference, it came up that Fannie and Freddie are way below their annual
Oh,
allocations.
they said that. Yeah.
Yeah.
Yeah,
And
that's right.
so people are talking about, oh, the banks are in bad shape. The banks are in bad shape. What are we going to do? But some of the debt folks at the conference were like, well, yeah, but Fannie and Freddie are just sitting there on a pile of money that they haven't used yet. So, but of course, that's only for loans of $1 million or more. But if you're
Right.
looking at smaller deals, or you're looking at things like assets that are not multifamily, you're having a much harder time getting debt. And who knows like what the corporate lending environment is like right now. That's not saying I have any real kind of
Yeah, well,
connection.
it's not good. I mean, I'm in the valley where there's a lot of people trying to raise, and it's going to be pretty messy. I think, at least in the Silicon Valley, it's the brand new companies, the
Yeah.
2 or 3 person startup, they're getting funded with 100K, 200K deals. But if you're or like you're a B or a C round, ooh, not a lot of fun today.
Yeah, that's definitely true. And I think startups are going to be, certainly hit on this, right? Because the source of money for for these funds is drying up, and people are just more skittish in general, right? But
Yeah.
back to regional banks. I mean, so where do you see this going? I know we've got a couple more that are now like the teetering list. It does remind me a little bit of like the great financial crisis, where we had the same kind of like, okay, AIG goes down, all right, look at Lehman, they're not doing so well now, and then everyone is sort of watching and waiting, Wachovia and
Yep. Remember
all those
that?
other
Yeah,
banks.
Countrywide and
Yeah, sort of
WAMU. Yeah.
what's the next domino to fall, right? And so
Yeah.
uh I
Go,
mean, feels a little different to me than then, but I don't know. I mean, it's not good news either, right? I mean,
No, I think what we're going to have is kind of 18 months of the banking sector getting smaller, the big getting bigger, the medium getting bigger.
yeah,
I think what we will have at the end of 2024 is the too big to fail will be bigger.
yeah,
We'll have really, really small banks that are well run, and like the middle will be hollowed out. I think the middle, in the middle being defined, maybe 50 billion to 150 billion, maybe somewhere in there. It's going to be less folks. I think regulations is coming, which is really going to penalize kind of folks in the middle. So they're going to acquire to get big, or they're going to shrink. And I think we have less banks. I think coming into this crisis, we had something like 4,000. In the 80s, I think we had like 20,000. Right.
right.
So we're on a trend to have less institutions, which I'm not a fan of,
Yeah,
but I think it's coming. Right. I think it's kind of where we are in the process.
yeah. I mean, part of that has definitely been sort of like the big gobbling up the small, but also I think there's been, I don't, I mean, this is like getting really off track, but I'm curious what you think. Like, I kind of feel like when you and I were growing up, the idea was, if you started a company, the idea was, well, you're going to start a company, you're going to run this company, and then like, you can hand it to your children and they're going to run it. And
Yep.
like you're not in it for like, 5
The
years.
quick buck, the flip.
Yeah.
The flip.
Whereas
Yeah.
now it seems like everybody you talk to who starts a company, they're starting it with the idea of selling it
Yeah. What's the
in a
exit?
couple of years. As soon as it is all the whole point of this is not to like start a great business and run a great business and have this be your career. It's like make a quick killing, right? And so I think that has infected the whole economy, right? And so where you have these like regional banks that used to do really well, local and regional banks that used to be like sort of an integral part of their community where they knew all the local business people and they had relationships and they hung out at the country club and they, they were kind of pillars of the community. Well, now all those folks too are like, well, how can we sell to somebody bigger and cash out and take our chips off the table and retire? And it's it's just part of the financialization of the economy. So I think that just leads inevitably to this, the big continuing to gobble up the small, to the point where competition is reduced greatly, and that's not good for capitalism.
Yeah.
It's just
No, competition is a key theme to this, as is punishing bad behavior. So I'm on kind of both sides, right?
yeah.
And yeah, I think there is a lot of.
I mean, they're related, aren't they, though? Because you
Oh,
can't,
absolutely.
because the bigger the banks get, the more systemically important they get, and the less you can punish them. If you have 20,000 banks and, and you have of those 20,000, you have four, I don't know, 100
5%, whatever it is, it's
that
nothing.
that
Yeah.
have, 100 billion in assets. Like any one of them can go down and it really is not going to create that much of an issue. But when you continue to
Yes.
consolidate, then each one of them becomes more important systemically. And then
Correct.
you can't, and then basically they all get a get out of jail free card because they're too important, they're too big to fail, right? And so that's
Well,
mission.
that's what I think is coming. I think regulation is going to go up because again, I think Jerome Powell said yesterday, no one thought that a bank run could happen in 2 days.
Yeah,
Right? Silicon Valley Bank had 80% of their capital taken out in under 2 days. And knowing somebody who was a part of that, it was actually 8 hours.
yeah.
It was 8 hours. It was all gone. That's just
Well,
digital.
I mean, I honestly think that, rather than more regulation, I would just like to see more antitrust enforcement.
Yeah.
I think that's like the answer that like nobody wants to deal with, right? But they should be breaking up big banks and big players rather than just trying to constrain how they act.
Rather than letting JP Morgan get another 100 billion in deposits by taking over First Republic.
Yeah, I mean, it just continues. The system is better when it's more diversified, right? When it's more
Yeah.
when it's more fragmented. It's systemically stronger than when it's consolidated. So I think that the problem really has been that, the US government's antitrust function has basically been like completely abdicated for a generation, right? And there's just too much consolidation throughout the economy, and the big get bigger, and then that contributes to the inequality that we have, which is a societal problem. I mean, so there's just so much that stems from consolidation, and so anyway.
There we go. Well, Jonathan, we got one more topic to get to, but before we do, how can people follow you?
Yeah, absolutely. So if you want to, I'm happy to rant about all this stuff if you want on my own time, not take up Michael's time. But yeah, come and join my Facebook group, the Apartment Investors Club on Facebook. You can also find me at apartmentinvestorsclub.com, get my free download. And if you're interested in investing with me, swing by Two Bridges Asset Management. The easiest way to find that is to Google it and join my investor list there.
Thank you so much.